All right, let's talk about a trading method that's got everyone buzzing, ICT. We're going to break down what it is, and we're going to do it fast, in about 90 seconds. So let's just jump right in. You know that feeling, right? You place a trade, you set your stop loss like you're supposed to, and then you just watch as the price dives just low enough to kick you out, only to then skyrocket in the exact direction you predicted. It feels personal, doesn't it? Almost like you're being hunted. Well, that exact feeling? That's what we call the trader's dilemma. And believe it or not, there's a whole trading philosophy built on the idea that maybe, just maybe, it's not all in your head. And that brings us to ICT, which stands for Inner Circle Trader. It's a whole different way of looking at the market. Forget the usual indicators. ICT focuses on one thing and one thing only, figuring out what the smart money, the big banks and institutions, are really doing. So the whole idea is pretty simple when you think about it. Stop trading like everyone else and instead learn to read the footprints of the financial giants who are actually pushing the market around. And here it is, the single most important idea in all of ICT. The price you see on the chart isn't just moving randomly. Nope. According to this theory, it's moving with a very specific purpose: to hunt for liquidity. So what in the world is liquidity? Well, put simply, it's all those orders piling up, especially the stop losses that everyday traders like us set. The theory goes that smart money actually engineers price swings to hit those stops, which creates the massive pool of orders they need to fill their own huge positions. And this is how they do it. They create these clever little traps that ICT traders call inducements. They're designed for one reason and one reason only: to trick retail traders into giving up their positions, which, you guessed it, creates that liquidity the big players are after. But here's the cool part. These aggressive, engineered moves, they leave behind fingerprints, clues. An ICT trader looks for things like this: fair value gap. It's basically an imbalance on the chart that screams, hey, smart money was here, and gives traders a potential hot spot to watch. Okay, but let's hit pause and get real for a second. The promise of ICT is huge, a deeper understanding of why the market moves. But the reality? It is incredibly complex. The learning curve is super steep, and honestly, whether or not it's consistently profitable is still a pretty hot debate. So let's be crystal clear. This is not some kind of magic formula. Think of it more as a powerful but very complicated framework. Any success you might have with it comes down to your own skill, a whole lot of patience, and a really deep grasp of its many, many concepts. Which really brings us to the final question, doesn't it? Is ICT a genuine map to the market's hidden rules, or is it just a very complex theory? In the end, it seems the answer isn't in the system itself, but in the hands of the trader who decides to wield it.